Hi everyone, good morning. So previously we have discussed about mortgage-backed securities. Uh, so how a mortgage-backed security is different from an asset-backed securities? And before that, let's understand what does a mortgage-backed security means. And see, as you can see here, so in mortgage-backed security is actually a securitized product backed by residential or commercial mortgages. And the cash flow sources are the monthly payments. We discussed about this thing. And the cash flow, the mortgages, the monthly payments are actually a part of principal and interest. And then the types of mortgage, types of mortgage-backed securities are pass-through mortgage-backed securities and a collateralized mortgage-backed securities, which are the which are also known as CMOs. So pass-through mortgage-backed securities, investor receives a proportional cash flow, and there is no tranching. That's important about it. So these are pass-through mortgage-backed securities. And when we talk about collateralized mortgage-backed securities, so these use different tranche in different maturities, and the risk levels are there. And the key risks when which are actually which are when we look at these risks from the mortgage-backed securities perspective. So these are prepayment risk, interest rate risk, and credit risks. So as you can see here, I've tried to depict it all in a diagram, in a image picture. So mortgage loan to a property buyer, bank mortgages loan to the property buyer. The person in return actually pays interest and repays loan. Then what does the bank do is, so the mortgage loan, the loan which the bank has actually given to the borrower, now the bank takes that loan, break it into different bonds here, and then these mortgage-backed securities are sold to the investors, those who actually want to invest in mortgage-backed securities. And when we talk about mortgage-backed securities, relatively the interest rates are lower because there is something mortgaged, there is an underlying asset, and the underlying asset is with the bank till the tenure of the loan completes, till the borrower actually has paid every dime, every single rupee, every single dollar to the uh, person who actually owns that. So that's the that's we actually discussed about in the previous lecture, previous episode. And now we are going to start with what does uh, the structure. Let's discuss, since we are talking about it, let's also discuss the structure of this mortgage-backed security. So this is also telling about the same big thing. So the collateral is actually converted into mortgage-backed securities, and the underlying is the cash flow. And based on the cash flow is dependent on the principal and the interest. And later on, this interest is actually given to the investors. And the principal is the face value, which is paid at the last to the bondholders. Okay, just try to process this diagram. And here, if you look at this diagram, you can see how the tranching is done. So the tranches are made from senior to mezzanine to equity. And this is The classification of tranching uh, based on the risk, these are classified, and you on your risk appetite are going to invest in whether you want a senior debt, you want to invest in mezzanine, or you want to invest in equity. So it's totally dependent on the investor. So now let's move to our asset-backed securities. In today's lecture, so in earlier lecture, we introduced the concept of securitization, the transformation of illiquid loans into tradable securities. And today's lecture actually focuses on specific and uh, extremely important application of securitization. That's asset-backed securities. And in asset-backed securities represent one of the clearest example of how securitization and tranching actually works together. And you cannot properly understand asset-backed securities without understanding the tranching. And you cannot understand tranching without understanding why securitization exists in the first place. So today's episode, we will try to understand three things, which is that we'll try to explain what ABS are, asset-backed securities. We will try to show how tranching is used inside asset-backed securities, and repeatedly how it's repeatedly connected, how you repeatedly connect ABS back to the core logic of securitization. And it's very important to understand asset-backed securities because earlier also I've told you that when we will be discussing about the debt waterfall structure, before we get to the debt waterfall structure, it's very important that you understand all type of securities which are involved, how a company raises debt. A company raises different type of debt. Uh, Different type of debt means there are multiple type of debts which benefits company in a specific manner, and this actually creates a very specific debt structure, a very specific the more debt securities the company uses, so the more complex the structure of the company, the capital structure of the company gets. And because of the type of security, you need to understand every type of security before you start calculating the numbers, before you start jumping on the numbers, before you start plugging in the numbers in your Excel. So you need to understand how these securities are going to impact your valuation, your calculations. So that's why, and if a company has actually raised money through asset-backed securities, or let's say, for example, you are building a model for a financial institution, or you are building a model for a bank, the non-bank and NBFC. Let's say you are non-banking financial corporations are there. There are multiple type of companies. Let's say you are doing this for an insurance company. So insurance companies also have these kind of securities because there is always a surplus of money with the insurance companies. If you ever, if you take insurance, you car insurance. So if just an example, just an hypothetical example, just for for you to understand this thing. So those companies which actually have cash rich, no, those companies which are cash rich or have excess cash, so either they actually have to generate more return on. They cannot keep that money with themselves. So they actually have to generate that money, and that's the problem with money. You actually have to constantly grow. You actually have to constantly give returns on your money because of all the other factors, risk, or because of inflationary pressure. Just the very basic example, inflationary pressure, yes, because of time value of money, because of the depreciating value of money. Uh, so that's the main purpose of understanding when we talk about finances. And being financially literate doesn't make you a cheap person, doesn't makes you the, you do not spend a lot of money, or you do not spend for what's required, what's not required. So once you understand about the finances, uh, once you are financially literate, your perspective actually changes. So that's one thing. So that's about what does so securities are security backed mortgages. This definition is short but extremely important. So let's unpack it carefully. Uh, a security is actually a financial instrument that can be bought and sold and has an expected return and has risk also. So it of security can be a financial instrument when it fulfills a few conditions that it can be bought, can be bought. We can buy this. We can expect a return. There is a certain risk involved also, and it's owned by somebody. We need to own it also. Can be bought means specifically we can own it. Can be owned by an investor and backed by non-mortgage assets means it's a non-mortgage asset means that to understand this thing now, asset-backed securities, if there is an auto loan, there is a credit card receivable, uh, if there is a student loan, if there is equipment lease, so unless until the bank keeps it with themselves, let's say you have taken an auto loan for a car and the loan is for 5 years. Would it make sense that the bank keeps your property with themselves and pay the installments, EMIs? So that doesn't make sense. So that's why when we talk about asset-backed securities, the non-mortgage, these securities are backed by non-mortgage assets because if you are a borrower, so you will be using this car car or your vehicle. So you will be using this vehicle and bank has paid on behalf of you to the company. So let's say it's a Tesla. So bank has paid to the Tesla, the company, and now the bank is actually now you are paying back to the bank in the form of EMIs. And for all that trouble the bank actually had to go through, the bank is charging you a interest rate. And when we talk about auto loans, when we talk about ABSs and MBS, now if the vehicle is with the borrower and if the property is with the bank, so that's what differentiates the risk and the return factor. uh, it's very arguable that I mean you might have different opinions. So if we look at this situation, there is a situation where uh, there could be a situation where you might find that asset-backed securities should have a higher risk and mortgage-backed securities have a lower risk, and that's why uh, that's the reason why if you were to get a home or commercial loan, uh, you might get it at a lower interest rate as compared to ABS, asset-backed security, because there is a lot of risk involved. And when we talk about auto loan specifically, so there is insurance also. So there are insurance requirements also. Uh, these you can so there is insurance, there is pollution check, and there is maintenance of the vehicle, and there is other conditions also. So you can consider those things as the do's and don'ts, do's and don'ts about uh, the servicing of the vehicle. So I hope what I am trying to deliver here, you are able to understand what I'm trying to say. Okay, so let's move further. So backed by non-mortgage assets means that the cash flows that pay the investors come from asset other than mortgages, and these assets are contractual loans and or receivables. So it's core that an ABS. So I mean, asset-backed securities, there is a claim on the cash flows generated by the pool of non-mortgage loans. And this already tells us something crucial, that ABS are not standalone instruments. They are created through securitization, and they depend entirely on the pooling and tranching. So if I am just similar to this, I have 100 loans and I am 100 loans of such auto loans, or 100 auto loans, and I'm pooling it uh, in a fund of $100 million, and then I am issuing it to my borrowers. I'm issuing it to my investors, and the payment of EMI I'm paying using that payment to pay back my borrowers. So that's what. So everything is organized now, and the bank is going to enjoy the spread. The spread means the difference between the cost and the generation of, let's say it's 15% for that individual employee or individual person. So the bank is going to, and the spread means 15 minus 10%. That's the difference. That's just a fancy name to say spread. Sorry, just a fancy name to represent difference. So this is how the whole process of securitization and tranching works together, so that everyone benefits. That's the whole purpose, and uh, that's why it's one of the greatest invention of the last few decades. But there are always pros and cons involved. So if there is an upside, there is also a downside also. So if there is a return, then there is a risk also involved. So that's why the 2008 debt crisis actually happened. Okay. So common ABS asset-backed securities asset pools is that ABS can be created from many different type of assets, but they all share common characteristics. So uh, large number of similar loans, predictable cash flows, and diversifiable individual risk. And these are most common asset pools. When we talk about auto loan in particular, so auto loan is one of the oldest and the most successful ABS category. These are medium term loans, said auto loans. So, regular monthly payments is there involved, and the vehicle is collateralized, and historically low default correlation has been reported in an auto loan section. And why auto loans are ideal for securitization is because there are thousands of similar loans. They are easy to pool. To make a pool means I am clubbing all these auto loans together. So that's pooling. That's pooling. Uh, don't get confused. It's not that swimming pool, but it's pooling means I am bringing everything in a basket. That's pooling basically. And they actually have a stable payment behavior, and yes, it's also collateralized, but the asset is with the borrower. And if people defaults on their payments, so what does the bank does is they take over the asset, because in the unless you have paid everything, the document says that it's the name, the documents are named to the bank. And once you have paid everything, so the bank reissues a statement, a no objection certificate, and you get uh, your own registration certificate, RC, with your name. So that's the whole process. When we talk about credit card receivables, the characteristics of credit card receivables is that there are revolving balances, there are high interest rates, and short and effective maturity. But there is no physical collateral when we talk about credit card receivables. And even unsecured loans can be securitized. And so this is actually kind of unsecured. So credit card receivables means if I am Shop now, buy later. Shop now, buy later. Oh, sorry. Shop now, pay later. That's a new model. Shop now, pay later. Or you can break things into EMIs. So there are very lucrative offers when it comes to buying something on an e-commerce website. So you might have noticed that these kind of structures are available on e-commerce platforms. So what does that means is that again, if you are if you are talking about credit card receivables, so the core concept here is that using these instruments, the bank try to uh, generate a cash flow. The concept applies here. So they actually try to generate a cash flow here, cash flow. And using this cash flow, so if you are uh, using something, you are buying something and you do not want to pay your money upfront. You do not want to spend your money upfront. So you will go to the bank and bank will help you purchase that thing first. But later on, you actually have to pay it to the bank. And based on your credit history, credit rating, your personal credit rating, you will be given a certain, you actually have to pay a certain amount of return to the bank also. So based on that, so if the concept here applies similarly, the way it applies to the other kind of securities. And similarly to the student loans, when we talk about student loans, this concept applies. The student loans are backed by government guarantee loans and private education loans. And they typically have long tenures. There is grace periods, income dependent repayment features, and these complexities make tranching even more critical for risk management. So, student loans, why government uh, gives us student loans so that people can study, and why education is important? Because education, uh, I do not think that I need to explain it to you why education is important if you are watching this video. So, to boost education, government does give government give back. I mean, government. These actually loans are government guarantee loans. So it's in government interest. It's in government's interest that people study. It's in government's interest that uh, to have a young, educated workforce, because these are the building blocks of a nation, and uh, the government also runs the nation just like business. So there is nothing emotional about it. There is nothing. It will all make sense if you follow the markets, how different companies developing and underdeveloped nations. The models, the government models applied in these kind of nations. If you look at their policies by the government, the policies of these nations, so you will be able to understand the perspective of government. Okay, and when we talk about equipment leasing, so equipment leasing, these setback securities are backed by machinery leasing, aircraft leasing is an example, industrial equipment rentals, equipment leases are so there, so wheresoever there is heavy capital investment, so they try to loan it out, and bank actually, so what's so I mean, if you are not spending your money, and if you are taking loan from bank, so later on, so you actually you are creating a cash flow for the bank, and this will actually help the bank to pay back to the investors. And bank first, the bank what the bank need to do is that the bank need to do is to securitize its debt. So it will sell it out to the market and it will secure, because if there is an issue in the banking system, so it creates economic crisis. And that's why the government actually has bought so the government actually has I mean, the government has this securitization. The government has let it happen in the economy, and that's why there is a lot of rules and regulations when we talk about securitization and tranching, and not everyone can do this. Okay, so the cash flows from lease payments rather than loan repayments. And again, the key theme here is that it generates predictable cash flows, and so that it could be securitized. Now, uh, now let's understand why ABS actually exists. So before discussing tranching, we must remind ourselves that why securitization exists at all. So financial institutions face three core problems: that liquid, loans are illiquid, and loans tie up capital, and loans concentrate risk on balance sheet, on the bank's balance sheet. And ABS, asset-backed securities, actually solve this problem. Uh, Through securitization, loans are pooled, transferred to an SPV, and converted into tradable securities, sold to investors. And however, and this is crucial, the securitization is alone not enough. This is not enough. If investors were focused on bear equal risk, many would simply not invest. And this is where tranching actually enters into the picture. So I do not want, yeah, if okay, I am doing securitization of a loans, I am securitizing a pool of assets. But if I am giving every investor the same return, so nobody will invest into that. And for that, we actually need to do a tranching. So if you invest here, you will get the minimum here, here, here. And if you invest here, so you will get the maximum. But the risk will be high here and the risk will be low here. Low risk, low return. Okay, now let's talk about senior ABS. So senior ABS is here on the tranching. When you talk about tranching, so senior ABS are represented at top. So senior ABSs are actually paid first, suffer losses only after all the junior tranches are wiped out, and typically receive high credit rating like AAA or AA. And why senior tranches are considered safe is because they are protected by subordinates. So this means these are a subordination. And equity and mezzanine tranches act as a shock absorber. Who buys these kind of loans? So pension funds are there, insurance companies, conservative institutional investors. And if you look at uh, these uh, these buyers, these investors, so understand this thing, they actually have a long time horizon. If you are a pension fund, and okay, if you are a individual, a working individual, you can be anyone. So since you started your journey, your work life, since you, so you are, as per government, you are required to make monthly installments, monthly payments, and the government gives you a tax benefit till you reach a age of 60 or 65 in some countries. So you need to put your money in the pension fund, put your money, some money into provident funds so that when you retire at the age of 65, you have enough money to support yourself. So if you invest today and pension funds, I understand. Okay. So what you need to understand is that every now and then, not everybody will be, everybody will turn 60, 60, 65. So what they can do is they can invest here, and the horizon is long, maybe 25, 35, or 45. It depends on when are you starting. So maybe 20. So you started investing in the pension fund. Government also gives you tax benefits. And similarly for insurance companies where they would not be needing money. The pension funds won't be needing your money immediately. But uh, because of the compounding effect throughout all these years, so just similar to amortization, try to make it in a reverse order. So you start from zero, and similar you keep on adding uh, EMIs every month at at a specific at a specific rate of return. So at the end of the period, you get a large corpus of money, and now you can enjoy. You can, if you are, so you can fulfill all your commitments using that money. That's pretty much it. When we talk about mezzanine loans, let's talk about mezzanine loans. So mezzanine tranche is paid after the senior tranche, absorb losses after equity, but before senior, and offer higher yield than senior tranches. So the risk actually is here higher as compared to your senior tranche. So this actually pays higher return uh, than the senior tranche. And this tranche is exists. This tranche exists because to balance the risk and return appeal, it actually appeals to investors willing to take some more credit risk. And here, similarly, banks or asset managers buy this, or yield seeking investors also, return seeking investors buy these kind of securities. So understand this thing when you are, okay, since we are talking about this, let me just give you an example. So if you have $1,000 or 1,000 rupees, and based on your calculation, based on your education, you need to make a portfolio. So based on the risk and the return, let's assume that you are investing 33%. The more you are diversifying your portfolio, that's the portfolio diversification. So if you are taking position in all these three, and given on the return, uh, let's say this is giving you 5%, this is giving you 7% because the risk is high, and this is giving you 10%. Having everything equally in your portfolio will not, this will not be optimized portfolio. So how much return you want based on these factors and the market conditions and the risk and the return factors, you can calculate a optimal portfolio, and you keep on balancing it throughout, and you keep on tracking it. And okay, let's get back to the reading. So when we talk about equity, when we talk about the equity ABS, so These are the last paid. These are the characteristics of equity tranches. So absorb the losses first, usually underrated and extremely risky when we talk about equity, and potentially very high returns are there. If there are returns, so they will be rewarded accordingly. Now I hope this much is clear. And now let's move to the other kind of pool investments and structured products. So there are other than ABS and MBS. So there are other pool investment and structured products. So these are collateralized debt obligations. These are collateralized loan obligations, mutual funds, indirect pooling. It's example of indirect pooling, and there are exchange traded funds. Which everyone is aware about. So when we talk about the CDOs, the collateralized debt obligations, these are highly tranched. There are pool of bonds, loans, and ABS and MBS. These played a very major role in 2008 crisis also. Collateralized debt obligations, these are backed uh, by the corporate loans, structured similar to core CDOs and generally safer due to better underwriting. And when we talk about mutual funds, so there is a pool. I mean, mutual fund actually means that it's a pool investor money and invest in diversified assets, but they also have tranching. So all investors shares risk equally, and there is no waterfall structure and no credit enhancement. So this actually has a mutual fund do not have any tranching. When we talk about the exchange traded funds, so these actually are traded on the stock exchange, are transparent, highly liquid, and no waterfall payments. But the ETF pool ownership, not the cash flows. And this is actually the factors when we talk about mutual funds, CDOs, CMOs, CLOs, and exchange traded funds. Tranching is essential in mortgage-backed securities is because it converts risky loan into investment-grade securities. Attracts different investors like pension funds go for senior tranches, banks go for mezzanine tranching, uh, hedge funds go for equity tranches, and this depends on the investor's appetite for risk and return. Lower borrowing cost for originators also. This lowers the cost for loan originators because senior tranche demand low yield. Overall funding costs also decline with that, and originators can lend money more cheaply. And that's pretty much it about the ABS and MBS. The overall of concept, I hope you guys have understood. And in the last, when we talk about the securitization, the process, this is actually a process of pooling financial assets and converting them into tradable securities through an SPV, means special purpose vehicle. And asset-backed securities are securitized products backed by non-mortgage assets such as auto loans, credit card receivables, student loans, and equipment leases. And tranching is the key mechanism that divides ABS into layers with different risk and return profiles. Losses are absorbed sequentially, providing credit enhancement to senior tranches and enabling uh, participation by a wide range of investors. Right. So, thank you for attending this episode. My name is Deepak Bisht, and I will see you in next episode.